This video is looking at a basic consolidation with non-controlling interests, where our parent measures non-controlling interests at the proportionate share of the subsidiaries' net assets. The example that we have got here is on 1st of July 20XO. Michael, an investor, acquired 80% of Samuel's business ownership for $500 million. At the date of acquisition, Samuel's business had 200 million share capital, retained earnings of 280 million. What it means is its shareholders' equity equals 480 million and was represented by machinery of 480 billion. Michael had issued 500 million share capital and was used to acquire Samuel's business. The firms issued financial statements for 1st of July 20XO and 30th June 20X2, 2 years after. Michael parent measures the non-controlling interest at the proportionate share of Michael's subsidiaries' net assets. What it means is Michael makes an underlying assumption that it acquired 100% of goodwill for the consolidation purpose in Michael's subsidiary. Required on 30th June 20X2, show consolidation journal entries, and then second, show Michael Group's financial statements. On 1st of July 20X, On 1st of July 20XO, the balance sheet and the income statement are given. We can see that Michael parent issues share capital of 500 million and has an investment of 500 million, and this investment was used to acquire the shareholders' equity of Michael's subsidiary, where Samuel is there with 20% voting ownership, share ownership, was acquired, and it's represented by machinery, which is 480 million, and there is a difference here, which is goodwill on consolidation. On 1st of July 20XO, the income statement is given. Because it's at the beginning of the year, we don't see any figures here. So the income statement at the moment is 0. On 30th June 20X2, we have the Michael's balance sheet and the income statement, and Michael parent balance sheet and the income statement, and Michael's subsidiary balance sheet and income statement. We can see that Michael has issued share capital of 500 million and the investment is 500 million. There has been no operational activities, and there are no retained earnings. Therefore, that shows that Michael is a passive investor and has invested in Michael's subsidiary. Michael's subsidiary is actively operating. We can see that the income statement here, it has made profit. Profit after tax is 119 million, and the share capital is intact. It was 200 million at the time of acquisition, and it is still 200 million. But the retained earnings have increased. The prior period earnings also have increased from 280 million that was there before, and now it is the prior earnings are 581 million, and then there is also current period earning of 119 million. So we must now do the consolidation journal entries. Our first journal entry is to eliminate the investment what Michael parent has made in Michael subsidiary. When we make that elimination, 500 million was invested, but we can see the share capital was 200 million. That is the total share capital. But what Michael acquired was 80% of that. So therefore, that equals 160. Retained earnings was, we saw the retained earnings was 280 million. Michael acquired 80% of that at the date of acquisition, and that equals 224. And the difference between the debits and the credits is the goodwill on consolidation. And Michael parent has acquired 100% of this goodwill. Our second journal entry, consolidation entry, is for the non-controlling interest. There's some authors consider this as a calculation, and some use it as journal entries, as consolidation entries. Here we use it as consolidation entries. We can see that our initial investment was 200 share capital here and 280 retained earnings. So 200 of share capital. In that 200 of share capital, Samuel still has 20% of that, and share capital is 40, and retained earnings of 280, Samuel still has 20% of that, that's 56. The non-controlling interest that is assigned to Samuel is 96. Our next consolidation adjustment relates to recognizing Samuel's non-controlling interest in the subsidiary from the date of acquisition to the beginning of the current period. This is the stage 2 calculation. The retained earnings that increase was from 280, and it was the prior period amount was 581. So the non-controlling interest of Samuel increased by 60.2 million. So 581 minus 280, that equals to 301. And 301 into 20% is 60.2. Our next entry is for the current period, recognizing Samuel's non-controlling interest in the subsidiary equity for the current period. That's the profit after tax. Our profit after tax was 119 million. Take 119 million and 119 million. 119 into 20%, 23.8 million. So we take off from the profit after tax, and then we transfer that into Michael's non-controlling interest. Now let's do these adjustments in our consolidation worksheet. In our consolidation worksheet at 30th June 20x2, we got Michael parent and Michael subsidiary, balance sheet, and the income statement. And then we got the adjustment columns, debit and credit. In our first adjustment, we eliminated the investment. So that's 500 million. We eliminated against the share capital of Michael's subsidiary, but Michael had only 80% of acquisition there. So we eliminated only 160, not 200. And then Michael's retained earnings also we eliminated not 280 but 80% of that, which is 224. As a result, we saw that there was an investment for hidden assets, a collection of hidden assets that cannot be individually identified, which is called the goodwill, and it's on consolidation, and that is the goodwill on consolidation. So that was our first journal entry. In our second journal entry, we transferred the share capital, that's for Samuel, and then the retained earnings of the prior period, that's at the date of acquisition, to Samuel. So 40 and 60.2 million we transferred. Then our third entry was for the current period transfer. For the current period, it was from retained earnings, 20% of that we transferred 23.8 million to the non-controlling interest. Once we have done that, we can now add across, keeping in mind which are debit accounts and which are credit accounts, and then be aware of the debit adjustments and credit adjustments so that we carefully, consciously add them across. We can see that the goodwill on acquisition 116 in the group, and there is machinery 480. There's cash that has built up over the years 420. Our net assets are 1016, that's represented by the shareholders' equity of 1016. The shareholders' equity includes Michael and then also Samuel's non-controlling interest in the subsidiary. That's represented by share capital of 500 million. So the parents, Michael parent share capital is 500 million here. The other share capital, the remaining of the subsidiary share capital, there was 20% remaining. We pass it on to non-controlling interests here because not entire 200 was not eliminated, only 160 was eliminated. Then the retained earnings, the prior retained earnings were eliminated at the date of acquisition, but anything after that, 80% of post-acquisition earnings is for Michael. It's Michael's subsidiary, and it then is assigned to Michael parent, but it's only 80% of that. And in the current period, it's also 80% of the profit after tax is assigned to Michael, and then 20% is assigned to Samuel because Samuel still has an interest in the subsidiary. So that's about the subsidiary's retained earnings and profit after tax. In the income statement, we can see the profit after tax was 119. But it can be attributed to Michael, how much is for the parent and how much is for the non-controlling interest. We saw that 23.8 of that, that's the 20% of that, has to be assigned to Samuel, and 80% is assigned to Michael. So we take off from this, we take off 20% of that, and then we assign that to non-controlling interest. Non-controlling interest in Michael's subsidiary. So if you look at the comprehensive income attributed to owners of Michael parent. Now Michael parent has ownership, total ownership of the parent, Michael parent, and also 80% ownership of Michael subsidiary. And owners of Michael parent has 95.2 million, and the non-controlling interest as Samuel in the subsidiary has an interest of 23.8 million. That brings us to the end of the video. Thanks for watching.